Should you buy a property now? Hello, everyone, and welcome back to another episode at Novarise, your channel for financial education. So, today we're going to talk about should you or should you not buy a property in today's circumstances. So, what we're going to do today is go over a pieces of article, analyze the current market conditions, and what you should do or what you can do to adapt to the changes in the market and see if it's going to be worth it for you to proceed and invest in a property, whether it's for you to live as a homeowner or for you to invest as a real estate investor. So without further ado, let's just go straight into the screen. So here we have an article from the Wall Street Journal that talks about how rent hikes are making buying a home even harder. So it's not a surprise that last year in 2021, there was a crazy hike in property prices. In fact, I have an article right here that confirms that last year, the rate where the properties increased in price was at a 14%, right? So the median home price was 357,300. So that wasn't a surprise. But what came to a surprise for me was that the rents actually increased parallel to the rate that the median home price was increasing. So just as housing prices were increased by an average of 14%, so did the rent, right? So while this might be great news for you as a real estate investor, because that means you're cash flowing more money, you get to charge more, it's not necessarily great news for the renter or even for you if your intention is to continue to expand your real estate portfolio. So there are a couple of key components here that I wanted to highlight. And then after that, we're going to dive into what you can do, any actionable items that you can implement on your end, right? So as we can see here, rising rents are often one of the main drivers in the recent bout of inflation, and they're also spurring many renters to try to buy a home as quickly as possible. Average monthly rents listed in the US jumped more than 14% year over year in December, and that put us at an 1877. So an average rent is costing nowadays 1,877 according to data from Redfin. And in major cities including Austin, Texas, and Miami, rents have increased by more than 30%. Okay, so this 14% is not standard across the board. It's an average of all 50 states. As you can see, there are some cities who have gone more in values, and those are usually cities that are in great demand, such as Austin and Miami, right? However, economists are still recommending that you buy a home as a way to protect yourself against inflation and build wealth, right? However, it's not that easy. Buyers are already contending with rising home prices, decreased inventory, which we know has added to the problem, aside from the fact that you have to deal with bidding wars and the prospect of higher mortgage rates. So that simply means that things are getting more expensive as the day go by. But in spite of all of this, they are still redoing their math and they're realizing that it is still cheaper to own a place now as opposed to renting it. Because in the past, typically, if you, let's say, live in a desirable neighborhood, for example, typically renting that property, it's a little bit cheaper than buying the property in that desirable area. So that used to be a strategy from homeowners so that they can save enough money for their down payment. And then that would allow them to, amass enough capital so that they can invest or they can buy that, lovely home that they so want in that desirable area. But now they're noticing that with the crazy rental increases, somewhere between 14% to 30%, that it no longer makes any sense because that money that you're saving for the down payment is being eaten by the high rent. So when you're doing the math and you compare rent with a 14% increase versus mortgage payment, now you're realizing that it's almost the same. So it doesn't make any sense to put all that money towards, a rental when you can be using that money and buying a property. Now, this applies in the scenario where you're living in a decent area. We're not talking about luxury apartments, luxury condos, high rises. Those are, a complete different ballgame. We're just talking about an average apartment where you can have a comfortable life, nothing crazy fancy, some place where you can live comfortable. Now is costing more money than an actual home that you get to buy for yourself. So what can you do, right? So back to the article here. A real estate agent said one of her clients, a first time home buyer in her 40s, felt moved to action by the rent increases. This client had been a lifelong renter, but when her rent increased, first by $50 a month, then by $200 a month, she grew interested in buying a home. Now, the article also talks about the impact of rising mortgage rates and how that is highly dependent on the buyer's total mortgage. So, for example, if a buyer comes in and is purchasing a $1 million home and is putting down 20% as a down payment, that means that person is left with an $800,000 mortgage. And so if that person were to sign up for a 30-year mortgage fixed at 2.75%, that means that the mortgage payment will be $3,200 every month. However, when you factor in a rent increase, and we're talking about an increase to 3.5%, now that mortgage payment has gone up to $3,600. So we're talking about a $400 difference. So those are some of the numbers that you definitely have to take into consideration and decide whether this is the right moment for you to invest in a property or not. And for that, what we're going to do, we're going to move into the tablet to sort of like consider your scenarios and consider your options to see where exactly you're falling in and what you can do about it. Okay, so depending on your situation, you can be on the side of a homeowner or you can be as an investor or perhaps even both, right? But it's important that you consider both scenarios, right? So we have these two scenarios right here, right? So based on the information that we got on the article, we learned that the rent has increased by 14%, which is not really good for the person who is currently renting and looking to become a homeowner because they are reducing their savings on the down payment, right? So that's not good. If you're on the investor side, that increase in rent of 14% is actually a good thing because that means your cash flow, it's going up. You're generating more money. Now, on both sides, regardless of what's happening, economists are recommending that you should buy today because you're looking for a way to protect yourselves against inflation, right? And so just like it will apply here on the side of a homeowner, the same thing applies here as a real estate investor because you want it to be a protection against inflation. Now, also, you need to consider the rate hike, meaning the interest rate, it's going to go up. And it's the same thing that will impact you as an investor as well. And here, if you are a renter looking to be a homeowner, you're faced with the scenario that you don't want to keep renting anymore because renting is becoming almost as expensive as being a homeowner. So might as well just own the home yourself. Versus here, yes, there's going to be an increased rate in March. What does it mean for you as a real estate investor who's looking to buy more properties? Is it going to be more expensive for you to invest or not, right? So those are the key questions that you want to ask yourself in terms of, hey, do I want to make a decision to buy? Yes or no, right? So these are the facts that you have to stick to. You cannot change those. Now, what we're going to do is consider your options right here. So once again, you're a renter looking to become a homeowner, and there's also the investor here on this side. So the key question you need to ask yourself is, one, as a homeowner, let's just focus on one side now, can you afford the monthly payments of your mortgage? Okay? Because yes, you are paying high rent, but let's say your rent, you're still comfortable at a rate of, I don't know, $2,200 a month. But maybe with the fact that the rates are going to increase sooner rather than later, somewhere in March, and we're already in February, how much is it going to increase? I keep hearing that the increase can go somewhere between 0.5% to 0.50%. And some are saying that it could go up as high as 1.75%. Some economists are saying out there. And so when you take this factor into account, your mortgage payment will definitely go up a lot higher. How much? I don't know, because it also depends on your credit. But let's say that if we were to take an average of these numbers, that your mortgage payment is now currently going up to $2,600. So this difference in $400 can either make you or break you, right? Because it's not the same having an extra $400 for you to pay for additional bills that you have, let's say your cell phone bill, or maybe having as a discretionary income for you to hang out with your friends, or why not? Maybe just simply saving it aside as a piggy bank for you to, build memories in the future through trips. So, can you afford to pay something this much expensive, right? And if the answer is yes, that's great. Keep it as a contender. Now, the next question you need to ask yourself is, do you have at least 6 months of reserve payment? Because this is not something that the lenders are going to ask you. Yes, they always ask you to have somewhere between 3 to 6 to 12 months in reserve funds, meaning emergency funds, right? So in the event that you get sick and you cannot work, or that maybe you lost your job, and then you have to tap into this fund so that you can continue to pay the lender until you figure out what to do next, or what type of job are you going to apply for next. So this is very important. Do you have enough to say, you know what, I can get myself into debt? Because remember, once you become a homeowner, you're the one that is paying for the mortgage. This is very different than on the investor side, because the mortgage is being paid by OPM, other people's money, which is the money that is collected from the rent. So in this case, when you're on the left side as a homeowner, that's coming out of your pocket. So can you afford to pay that? Yes or no? If the answer is yes, congratulations. It's still worth it, because you don't want to continue to pay a high rent and you prefer to invest your money in a home that you can call your own, and just put your savings towards it and build a future on it. But if none of these criterias are making sense, maybe you don't have enough, maybe you don't want to deal with being short by an additional $400 for becoming a homeowner, maybe you don't have enough cash reserves for you to protect yourself in the event of any surprises that happen in the future, you might want to hold off on it and maybe wait a little bit. Yes, prices are going to continue to increase, but based on what we heard, it's not going to go up to record high prices like in the 80s, where like the rates were double digits, right? So the rates are still currently relatively low for you to slowly build into something. You want to be able to get into a financial situation where you're comfortable, rather than just jump into a house just for the sake of saying, oh, I bought it, and now you're in a financial constraint with your funds. Now, on the investor side, right, does it make sense, yes or no, to continue to buy and add more properties to your rental portfolio? Well, the answer is pretty simple. Can your property still cash flow even with the higher rents that we were talking about here on the left side? If the answer is yes, it's a no-brainer. Yes, the properties are more expensive, but as you can see, some of the rents are going up as well. Last year, it went up by 14%. Now, is this a given? Does it mean that the rents are going to continue going up this year? Not necessarily. The rents can continue to go up, assuming everything remains constant. However, you have to pay attention to what's happening in your neighborhood, because sometimes the rate of crime changes. Sometimes a company can leave an area and move their headquarters to someplace else, so maybe jobs start decreasing. So that's why you shouldn't rely solely on, oh, the rents are going to increase in the future. If you're investing in a property to invest today, you have to make sure that it's cash flowing today. Extremely important, because you want it to cash flow today, meaning you want to make sure that after you pay your mortgage and then whatever operating costs that generates from renting that property, meaning property manager, the cost of cutting the grass, whatever utilities that you have to cover, you got to make sure that after paying all of these expenses today, you still can cash flow. You should not rely solely on the fact that rents are going to increase in the future, because for all I know, it might not happen. In fact, I even heard that in some states, the local government, it's already placing caps on how much rent you can raise. So if you're going to go ahead and rate the rent on some of your units, make sure you go ahead and do it now. Respecting market rates, of course. If the market rate is $1,200 and you want to raise it to $1,600, that's not going to be doable. Like, you have to respect the market as well. But if whatever rate increase, it's still within the boundaries of what's considered normal for your market, then go ahead, you do that before you get hit with the rent cap and you will no longer be able to cash flow a higher amount anymore. So once again, if you're an investor, as long as the property is cash flowing, then the answer is yes, you should still go ahead and invest in a property. What you don't want is be in a negative cash flow and worry that the rent proceeds are not enough to pay for your investment and you still have to come up with money out of your own personal pocket to pay for that investment. That's when it doesn't make any sense to invest. Now, speaking of real estate investors, if you're looking to learn how to run the numbers, make sure your property is cash flowing so that way you can analyze the deal properly and learn whether that's the right deal for you, here is a link to a webinar that you can sign up for. And it will teach you everything you need to know about how to run the numbers properly. And the webinar is free. So all you got to do is to make sure that you pick a date and time that works out best for you and show up with a pen and paper to take lots and lots of notes. So for those who are interested, I will see you at the webinar. Bye-bye.